In 2025, more cars were taken back from their owners than in any year since the financial collapse of 2009. Not traded in, not sold, repossessed, pulled out of driveways, off the street, out of employer parking lots, sometimes in front of the kids. 1.73 million vehicles in a single year, and the people losing them aren't who you'd expect. A warehouse supervisor in Central Ohio bought a truck he could afford on paper. 18 months later, it was gone. By the end of this video, you'll understand the financial mechanism that made that truck a trap the day he signed for it. That mechanism has a name, and almost nobody who signs the paperwork ever hears it. Start with the scale because the scale is the story. Over 100 million Americans currently carry an auto loan. Combined, they owe more than $1.66 trillion. That is more than the gross domestic product of Spain. And in the last 2 years, the share of those loans running late has climbed past levels this country saw during the Great Recession. Subprime borrowers hit 6.90% delinquent past 60 days in January 2026, the highest number recorded since tracking began in the early 1990s. Now the human anchor. The warehouse supervisor didn't buy recklessly. He put money down. He financed through the dealer, the way almost everyone does, because it was fast and the paperwork was already on the desk. His payment came in at $742 a month, close to the new national average of $750, a number that has climbed faster than wages for 4 straight years. He made every payment for a year and a half. Then his hours got cut. 1 missed payment turned into 2. By day 90, the truck was gone, and he still owed $6,100 on a vehicle he no longer had. Here is the villain system, and it isn't a person, it's a pipeline. Dealers don't just sell cars anymore. They originate loans, mark up the interest rate above what the bank actually approved, and collect a commission on that markup before the buyer drives off the lot. The loan is then bundled with thousands of others and sold to Wall Street as an asset-backed security. Dealer to lender to bond investor. The dealer gets paid immediately. The lender gets paid through the bond sale. The only party still exposed to the risk for the next 6 or 7 years is the person driving the car. But this is only the surface layer. To understand how we got here, go back 3 years, to the moment vehicle prices spiked and interest rates followed. Dealers needed a way to keep monthly payments from looking impossible on a sticker price that had climbed by thousands. 2022-2023 dealership showroom. Their answer wasn't to lower the price, it was to stretch the loan. 72 months became the new standard, then 84. 60 to 72 to 84 months. Some buyers were quietly pushed past 96. Longer terms, lower payments, higher risk. 3 words, then pause. Every extra year on a car loan does 2 things at once. It lowers the monthly number a salesperson can advertise, and it guarantees the borrower spends years owing more than the vehicle is worth, because cars depreciate faster than long loans get paid down. Lenders call this being underwater. In 2025, the average deficiency balance, the amount still owed after a repossessed car is resold at auction, climbed by 15%, because used vehicle values were falling at the exact moment loan balances stayed high. The depreciated by credit standards didn't stop this. They enabled it. Nearly 14% of new car buyers in September 2025 had credit scores below 650 the highest share since 2016 because dealers and lenders had learned that a longer term made a shaky borrower look approvable on paper. The system wasn't reckless by accident. It was structured to keep monthly payments low enough to close the sale, regardless of what happened in year 4, 5, or 6. Bad credit. Longer term. Bigger risk. 3 words. Then pause. By early 2025, the loans written during that stretch, 2022 through 2024, were reaching the age where trouble usually surfaces. Borrowers who'd been treading water for 2 years finally ran out of room. Overall 60-plus day delinquency reached 1.38%, higher than the 2009 peak of 1.33%. Even prime borrowers, the ones with strong credit, started showing cracks, with severe delinquencies among that group jumping over 300% year over year. B-roll note. News ticker-style graphic showing delinquency rate rising past 2009 line. But here's what most people get wrong. Most people assume repossession is bad luck, a borrower who overreached. The numbers tell a different story. It's the predictable output of a financing structure built to keep the sale moving, not the borrower solvent. Start with the average new car payment, $750 a month. Multiply that across a 72-month loan and the buyer commits $54,000 before interest is even added, for a vehicle that will be worth roughly half that the moment it's driven off the lot. That's more than the median American worker earns in a full year of pre-tax income, committed to a single depreciating asset. B-roll note, split screen, sticker price on one side, total cost with interest on the other. Now the deficiency balance, the gap left over after a bank repossesses and resells the car. In 2025, that gap widened by 15% as used vehicle values dropped roughly 13% from their peak, based on the Manheim Used Vehicle Value Index. That means a borrower can lose the car, lose every payment made toward it, and still owe the bank thousands afterward. The warehouse supervisor's $6,100 balance is now smaller than what many borrowers are left holding. B-roll note, animated bar showing what you paid, shrinking against what you still owe. Here's the number that should stop you. Total outstanding auto debt in America now sits above $1.66 trillion. Spread across 100 million borrowers, that's more debt per household tied up in depreciating metal than most previous generations carried in a first mortgage. B-roll note, comparison graphic, average auto debt versus historical starter home down payment. This is the counterintuitive turn. The conventional story says people are returning cars because they're irresponsible with money. The data says the opposite. Repossession rates are climbing fastest among prime, not subprime borrowers. Severe delinquency among strong credit buyers is up over 300% in a single year. These aren't people who never should have qualified. They're people who qualified under terms engineered to make the math work for the first 18 months and nobody after that. Resolving forward reference to the mechanism. The pipeline described earlier, dealer markup, loan securitization, risk transferred to the buyer, doesn't fail when the economy crashes. It fails quietly every single month to a predictable percentage of ordinary borrowers, because it was never actually pricing the risk of them. It was pricing the risk of the bond. Wall Street investors buying auto loan-backed securities are still seeing steady returns, according to industry reporting, even as the underlying borrowers default at a record pace, because the losses are modeled in and spread thin enough not to matter to the people who bought the bond. B-roll note, Wall Street ticker footage, contrast with empty driveway. The recovery rate on those repossessed vehicles has also fallen, down to roughly 48% of the loan balance at auction. Lenders are recovering less than half, and they still write the next loan the same way because the system, not any single borrower, is what's built to absorb the loss. Third forward reference, resolved here as well, the promise at the start of this video that you'd understand the mechanism is this. A car loan in 2026 isn't primarily a bet on your ability to pay. It's a financial product engineered around the moment of sale, with the years afterward treated as someone else's problem. If you've ever looked at your own car payment and felt like the math didn't quite add up, even though you never missed a payment, you were right, and almost no one will say so out loud. The monthly number was never designed to reflect what the vehicle was worth. It was designed to clear a credit approval and close a sale on a Saturday afternoon. Slow shot of a buyer signing paperwork, salesperson's hand pointing to signature line. Here's what most people don't realize. Dealers are not required to give you the interest rate the bank actually approved. In most states, they are legally permitted to mark it up and keep the difference, disclosed only in fine print most buyers never read before signing. That markup, multiplied across 100 million loans, is a large share of why the average payment now exceeds $750 a month, a number that has outpaced wage growth for 4 consecutive years. Simple chart, wage growth line flat against payment growth line rising. Watching this puts you ahead of most car buyers walking onto a lot this weekend, because you now know the 3 numbers that matter more than the sticker price. The interest rate the bank actually approved, the total cost across the full loan term, and what the vehicle will likely be worth in 18 months compared to what you'll still owe. Dealers rarely volunteer any of the three. All forward references are now resolved. The mechanism is the dealer-to-bond pipeline. The reveal is that prime borrowers, not just subprime ones, are being swept up. And the identity truth is that the payment was engineered for the sale, not for the 7 years after it. Which brings us to what happens next. The pipeline that repossessed 1.73 million vehicles in 2025 hasn't been redesigned. It's been reloaded, with new loans, written this year, on the same 72 and 84-month terms, sold into the same bond market, priced against the same borrowers who are already stretched thin. Every one of those new contracts carries the same clock. Somewhere in this country, a loan signed this month is already counting down to a morning 18 months from now, when a tow truck pulls into a driveway before sunrise, and the owner, like the supervisor in Ohio, will still be trying to figure out what he did wrong.